This is Roger Brooks Live, and today we have a very special report. You will learn how to avoid the looming catastrophe in government bond mutual funds. Our special guest is Gary Sinderbrand. You were one of the youngest advisors ever hired at Merrill Lynch at the age of 24. You broke into the top 5%.
2 years ago, Roger. It was great.
You broke into the top 5% of all Merrill Lynch advisors by your 30th birthday. You created a methodology to manage your client assets that was so effective, Merrill Lynch hired you to train others. Over the course of your career, you trained over 12,000 financial advisors. You have been through this before, Gary, back in 1987, where, as you say, you got hammered. That led to you creating your new method, which brought very little damage to you and your clients in 2008. And the same is holding true now. Gary, welcome to the show.
Thanks, Roger. Really do appreciate it. As you framed my background, I was thinking to myself, did I really do all that stuff? I actually did. And as I reflect back on it, there are a lot of similarities to what we're going through today. The background information is certainly different. And I want to preface whatever I say or discuss as to telling you, I don't know how this whole thing comes out. I'm not going to predict it. There's no way to know. That's the whole definition of a black swan event. We figure it out after the fact, but going through it is never fun. Having been through it before, there are certain things that I feel there's urgency to. Mistakes that I made the first time around that I didn't find out until long after the event was over. I avoided the second time in '08, but I see the exact same setup for the public right now. So I'd like to break, if I could, Roger, this down into two pieces. The first one, for those of us that are a little time compressed, is just take a couple of minutes and run through very quickly what the issues are. And the issues specifically relate to government bond mutual funds. These are mutual funds that invest in government bonds, which could be a long-term treasury bond or a treasury note, which is out to 10 years, or even a treasury bill, as well as mortgage-backed investments by the Government National Mortgage Association, or Ginnie Mae. All the securities in these funds are backed by the full faith and credit of the U.S. government. That does not mean, however, that you have a guarantee of getting your money back when you invest. So we're going to focus on those. We're going to focus on the situation that has developed over the past 30 to 60 days and what you can do about it. So very, very briefly, as the severity of the coronavirus became more widely known, investors who hate uncertainty exited risk assets in record amounts. When you want to get rid of risk, you want to park your money where you believe most strongly you'll see it again. And that historically has been either the United States dollar and or government securities issued by the United States Treasury. And that's exactly what people did. In fact, there were two ways that they could go about that. They could buy the bonds directly from Treasury Direct or their broker at little or no cost, or they could hire a professional and manage those investments into a government bond mutual fund, which is just a collection of investors who get together. It's normally denominated somewhere around $8, $9, $10, $12 per share. And you buy pieces of these government bonds that are professionally managed by mutual fund managers who have a great deal of experience and will reinvest your dividends for you and the like. Now, if interest rates stayed the same consistently throughout, no problem whatsoever. The issue with these funds, however, is that a massive amount of money came in right near where interest rates are right now, causing a dilution in return. If I bought it 10 years ago at a 4% yield and 1,000 of my closest friends bought it a month ago at a 1% yield, it's 1,000 to 1, my yield is more like 1%. The risk that we have, folks, is this. Interest rates will eventually normalize. Once they do, and rates start to move up in the 10-year treasury and the 30-year treasury, the net asset value of these funds are going to go down. We'll dig into this a little bit more in a few minutes, but it can't not happen. It happens every single time, and we'll go through and spend a little bit of time doing it. But the takeaway here is this. If you own a government bond mutual fund in your 401k, or you bought it to try and escape what the risks may be, or even if you've been in it for a long time, there has never been a better time to get out. Go to cash, go to treasury bills, go to short-term CDs, go to anything But sitting in these bond funds will cause you an enormous loss in your net asset value, your principal, when rates begin to return to normal. So that's kind of the 3-minute talk about what we're going to talk about in a little bit more detail, but it is urgent. You're not going to take a loss for the most part coming out now, but if you wait, I can promise you that you will. Rates will go back up, rates rise, bond prices fall.
And I'm not savvy in this at all. I guess the average person, it doesn't make sense, right? I don't understand like how this all works. When rates fall, it seems counterintuitive. Is that normal for people to have that perception?
It certainly is. The bond market is really an interesting spot. First of all, it's orders of magnitude larger than the stock market. The amount of debt out there at the government level and the corporate level just absolutely dwarfs the amount of equity that's available in the market. So the bond market is a very good forecaster of future economic activity, as well as inflation, deflation, possible recessions, and things like that. Now, interest rates were declining throughout the year in general, forecasting a slowdown in economic activity. But what we ended up seeing was once people were fleeing for safety, trying to get rid of risk, if you think about this, you had an unlimited amount of money chasing a finite object. So if you think about it in terms of supply and demand, and your demand far exceeds your supply, the value of that underlying asset is going to rise. It's just basic economics. If that underlying asset is a fixed income security that, let's say, before this all starts, is paying 4%, and then all the buyers come in at the same time, they're going to continuously bid the value of that asset higher and higher. So if I have a $1,000 bond paying 4%, that means I'm getting $40 a year. Now, if all of a sudden everybody wants to own that, and that bond is now trading at $2,000 because they're pushing the price up, what it means is I'm really only earning 2%. I've got a bond that's basically double in price, $2,000, and it's still paying me $40 a year. So as bond prices rise, interest rates fall, and the inverse happens as well. And we'll dig into this a little bit more when we get into the webinars next week. But all you need to do is just type in history of Treasury yields 2019 to 2020, and you will see the yields fall down close to 1%. In fact, at the 10-year rate, the yields were even negative for a time. So the demand drives the price of the bond. High demand, higher price equals lower yield. Now, investors are also competing with the Federal Reserve, who is essentially trying to keep liquidity in the system by injecting capital. And through a methodology called quantitative easing, what they're actually doing is using their balance sheet to bring bonds back in where they hold the bonds and they put liquidity into the system. It is a very unique time in finance. Does that answer your question, Roger?
It does. And, I'm just also thinking about the people that have 401ks. They may not even know. I'm out of a 401k. I used to have it, but I know when I did have it, I didn't know what it was made up of, right? I didn't know if it was invested into stocks, into bonds, into mutual funds. So can you just spend a couple of moments on informing people, if they do have a 401k, are they likely invested in these bonds that you're referring to?
I would say it's more than likely. I would say it's probably a certainty. Anyone that has looked at their 401k and you saw a really nice run up in value up until a couple of months ago, and then we just see the outright panic and liquidation, you would look at your 401k and you would say, okay, how can I become really safe? How can I preserve my capital? And you have a bunch of different choices, and a money market fund might have been one of them. But at the time you were doing it, it didn't say the money market fund was government guaranteed. So you see something with the words U.S. government in there, or U.S. treasuries. Oh, it's a bond. That's conservative. That's safe. I'm just going to go buy that. So you click, and all of a sudden the money just goes into whoever it happens to be. Let's say you're with Fidelity and you're going into the Fidelity government bond fund. It's got a good current yield, or a good trailing yield. It's all government paper, and that looks safe to you. So the odds are, and basically the numbers say the same thing, that an enormous amount, record amounts of money flowed from other risk type investments into government bond funds over the past several months. And I think we might even have a slide that illustrates that a little bit, that shows the amount of money that has come in. So if we punch to the next slide, Roger, if you can, there we go. Okay, so this one's a little tough to see, but you'll be able to look at it a little bit more closely if you download. But the top graph basically shows money flowing in and out of taxable bond funds. And the graph underneath it is close to being matched up, but the graph underneath it charts interest rates. Now, if we just focus on the two entries at the bottom, on the y-axis in both cases, the lower axis, what we're looking at is 2010 to 2000, I'm sorry, 2000, let's look at 2018 to 2020. And in the upper graph, what you can see above the blue line in the middle is a couple of spikes higher, the most recent spike being as of the end of January. It's continued higher. At the bottom, if you look where it says at the lowest current yield, these are the yields that people are investing their money at. Now, if you trace it backwards, what you can always see is every time interest rates begin to decline in earnest, within a year, the assets of these mutual funds spike because investors believe they're going to get a higher current yield than they can get in alternative investments. Conversely, when interest rates begin to rise, one would hope that the yield in your government bond funds would go back up. Unfortunately, that is not the case. As you can see, as rates rise, people actually end up liquidating their government bond funds because they begin to see a decline in the net asset value. So the first thing that happens that goes wrong with all of these funds is that your interest rate, your yield, is diluted. As interest rates decline and more money comes in, your dividends go down. I don't care what government bond fund you're in, put the symbol in, look at Yahoo or any other financial site, and you will see it has declined in yield, what you're earning, over the past 5 years, over the past 10 years, every single time. There's not one that's different. What you'll also see is that the yield you originally got, if you bought it 10 years ago, isn't remotely close to what you're currently getting. In fact, the current yield, which is the price you would pay for a new share, divided into the amount of income you're going to get on a lot of these funds is currently under 1%. Those are the bonds that make up this portfolio. Very, very misleading, extraordinarily dangerous to continue to hold these investments.
Okay, great. And do you want to go to your next slide, Gary?
Yeah, let's go to the next one. So this is a case study, and this just goes back 3 years. Let's assume you're an investor or you're in your 401k, and 3 years ago you had a choice. You were going to put money either into government bond or government bond fund. And you read up on both and you said, well, I don't know a lot about bonds, but Fidelity's a good name or Vanguard's a good name. And it's true, they are. And there are a lot of good names out there with all of these mutual fund companies. So Fidelity will use as an example, and you make the choice that you're going to go into this Fidelity Long-Term Government Securities Fund. And at the time, it's paying 3.5%. To check on your own, the symbol is FGOVX. Now, the other choice you could consider was a treasury bond that was paying 3%. And the bond that I was using in this example would mature in just a little bit more than 28 years. So you decide you're just going to go in and you're going to buy the government bond fund. Well, let's see what happens. If you look at the top, and I know it's a little tough to see, but your purchase date would be March 2017. You're purchasing it at a net asset value of $10.25. And today's date, if you were to liquidate it, actually as of a couple of days ago, you could actually sell that fund at a small profit of $11.17, a percentage change of just around 9%. Now, during that period, you earned total dividends divided by a $100,000 investment. Over 3 years, your total dividends were 5.45%. Your total return, when I add the 5.45 to the change in principal, is 14.41. So if you were to liquidate that fund today, you would walk out with an average annual return of about 4.8%. This is not horrible. This is preservation of principal. And this is something, if you have this now, you have an opportunity to come out intact for the most part. By the way, this fund charges you 45 basis points per year. So what that means is that $100,000, you are paying a manager to tell you that the US government is still paying on their bonds. You're paying them $450 a year. So over the course of that investment, 3 years, it's $1,350. Now let's take a look at the alternative. We can go back to that slide for a second, Roger. Let's look at the green. Let's assume that you decided to do a little bit of research. You opened an account with Treasury Direct and you bought a Treasury bond. No charge to open it. I don't know what the processing fee, maybe 25 bucks to buy it. So you paid for that bond $99,000. That was the price of the bond, March of 2017, 99 bucks. As of today, the price of that bond, interest rates have come down, is over $140 or $1,400 per bond. That is an increase overall of 41% plus. You earned 3 full coupon periods of 3% each for a total of 9%. So your overall rate of return is substantially higher than you had. In fact, your overall rate of return is roughly 50.8% versus 14. I like the 50% number a lot better than 14 because it annualizes out to just south of 17% per year. And if you were to liquidate that today, you would walk away with a gain on your investment, including your income, of roughly $149,000. Now, if you are in a 401k and you own this bond, obviously you could take it tax-free. If you're fortunate enough to own this bond currently and you decide to hold it, nothing wrong with that. Because even if interest rates were to go back up, your bond will still come due and rates would have to go up through 3% for you to see a loss. Now, we're not going to talk about trading the bond right now or doing anything else, but the bottom line is you had 2 choices in 2017. One, you could have bought an individual bond. The second choice, you could buy a bond fund. People like mutual funds. They make a lot of sense. But a good rule of thumb is this: if the underlying asset can be purchased by an individual at a lower cost and it's the exact same asset, always do it on your own. Or call your advisor and have them do it. And just explain it to them. I don't want to own the bond fund. Why? I don't know when it matures. And the advisor is going to go, hey, that's a good point. If we've got advisors on this call, or you've seen me in the past, what we're talking about in maturity dates is this term we call definition. If you cannot tell me when that thing matures, when I get my money back, that's not a bond. On the other hand, if we go back to that slide one last time, what we're going to see is that the income that I originally signed up for, which was 3.5% in the government securities fund, didn't maintain at 3.5% per year. In fact, right now that fund is paying less than 1% per year, but the Treasury bond is still paying 3%. So what's happening is this: I now own something I never intended to buy. I don't know when I'm going to get my money back, and I also don't know how much I'm getting paid in the meantime. The concept of what my dividends will be is referred to as permanence. So if you want to know if you own something that qualifies as a bond investment, not a bond-like investment, but a bond investment, a promise to get repaid, it's got to have a permanent return. It's going to pay this amount of money every single year as long as I hold it. When it matures or I sell it, I get all the money up till then, including the accrued interest. And I have to know when it matures. If I don't have those 2 things, I do not have a bond investment. I just got something else. Is it good? Is it bad? I don't know. Is it appropriate? But don't make the mistake of thinking that you actually own a bond. Now, if we go to the next slide, let's talk about what the potential damage is. So I don't know how long this thing lasts. I don't know if this thing starts to normalize in a month, 6 months, or a year. What I do know is that it ultimately will, and there is no compensation to wait. You're not being paid to hang around to wait and see what happens. Interest rates on the long end of the curve, beyond 10 years, are the lowest they've ever been in history. And they will probably stay that way until we see some form of resolution. Now, the bond market does a much better job of forecasting activity than the stock market does. So when you start to see the bond market correct a little bit, which means long-term rates begin to rise, that's a good leading indicator that the economy is beginning to recover. Now, let's assume they rise just to 2.5%. Keep in mind, the long-term average for 30-year Treasury bonds is 5%. So in the next 6 months, let's assume they rise back to 2.5. What that means is that a bond in the market right now would decline in price by roughly $15,000. The bonds that are held in these long-term government bond funds, that's a forecast of roughly what they would do. Is it 12,000? Is it 16 or 18,000 in 6 months? No one knows. What I can tell you is it's not going to have a plus sign next to it. It's going to have a minus sign next to it. And you're going to wonder, what happened to your principal? How do you lose principal in a government bond fund? And people are going to scratch their heads and they're going to call the mutual fund company. And the mutual fund company is going to tell you about it's open-ended, and you're going to scratch your head and say, what does that mean? Well, that means that all your friends could come in at lower and lower interest rates, and you're sharing your coupon with them. If we go back to the next step slide just again, and we see that now we're at 3% 1 year from now, just back to where we were in 17, you're going to see a 25% decline. Again, maybe it's 20, maybe it's 28, but there's not going to be a plus sign. That looks like an equity loss to me. So your safe money, you don't think can be exposed to a 25% loss. I am telling you flat out, I have been to this movie before because it happened to me in '87 in the mortgage-backed market, and I avoided it completely after that. When I adopted these two rules, maturity dates equal, I get my money back. That means I'm definable, and yield. How much do I get paid every month or every 6 months until that money comes back? That gives me permanence. Now, we go back to a normal average rate of return on the long end of the market at 5%, which has been the average rate of return in 1920 since 1926. And we're looking at declines in value here. You're going to be looking at proceeds of roughly half. Now, if you say, oh, well, that could never happen. No. No one 2 months ago predicted that this could ever happen. What I'm looking at are things that have happened in the past, and I went through the 80s when interest rates were at 15 to 17% on treasuries. I saw money market funds at 20%. This can happen. Just because it's not happened before doesn't mean it can't happen again. But these spikes in long-term interest rates can absolutely occur. So as we go through this period of unbelievable uncertainty, let's make sure that the things we count on are there, Roger. We don't want to wake up one day and see, why didn't I know about this sooner? If you're an investor and you're in a 401k, call your 401k company or go online and move it. If they try and talk you out of it, ignore them. Don't listen or say, when does this mature? Do I have a guarantee of getting my money back? They'll give you some long explanation, which basically they could sum up as saying no. So you can have that. If you're an advisor and you want to call your mutual fund wholesaler and ask them the same thing, basically they'll give you the reason why you want to stay in. They don't want to lose your asset. I don't blame them. I really don't. So go park it in the money market fund and stay in the same company. Money market funds right now are all being backed up by the Fed. So you're fine there. Don't sit in these funds because you'll look back on this opportunity to get out of them and you'll regret it when rates start to go back up.
Wow. Okay, and I think you have one final slide, Gary.
Yeah, let's take a look at that. Okay, so what do you do? Well, again, without predicting what's going to happen going forward, let's make certain that we can eliminate the risks that are there right now. The definition of risk, the best definition I ever heard, was it equals the possibility of loss, damage, or injury. Now, as an investment advisor for basically my entire adult life, I was obsessed with risk. I was obsessed first with identifying it, and then equally obsessed with trying to grind it down to as measurable and discernible a factor as possible. Here, you've got risk. There is no doubt about it. You are sitting with interest rate risk at exactly the wrong time. So what do you do in the meantime? Well, I'm not going to give you individual investment advice. The guidance I'm going to give you is, if you want to make certain your capital is preserved through this, to start to invest rationally as things develop, get out of your bond funds today. Go buy short-term T-bills. Go buy 2-year treasury notes. Go buy insured CDs, or just sit in a government guaranteed money market fund. Whether you're earning 1%, 1.25%, or 0%, it doesn't matter right now. Don't reach for the extra yield you think you're going to get in a government bond fund, because it's going to be the most expensive thing you have ever done. We've all taken a beating in the markets. If you had equities, you got hurt. No two ways about it. If you were following an asset allocation strategy and you had more money in bonds than you did actual bonds, you're coming through this okay. But if, as most of you who are in 401ks have, you're sitting in government bond funds specifically, get out today. It's going to pay you dividends going forward. Now, as we go forward and we think in terms of the webinars we're going to be producing, Roger, and how we're going to dig further into this, we're going to take a much deeper dive into the bond market, which a lot of people are paying attention to right now. But for now, let's just prevent the bleeding from getting any worse than it already is, and get the money someplace safe where it's going to be worth exactly what you think it's going to be worth.
And if it means putting your money to cash, you're okay with that as well?
Cash is awesome right now. We are in the middle of an event which is still evolving. There is no one out there that knows how this will come out. Anyone that's making a prediction is the same person that didn't give you the prediction that this would actually happen. In fact, there was only one analyst or one person I saw that actually could predict this, but I can't seem to find it. His name was Emmett Lathrop Brown, PhD. Some of you might know him as Doc Brown from Back to the Future, but my flux capacitor is offline, so I can't make the trip, and I haven't seen the DeLorean. It'd be lovely if we had that, but it's not there. So anyone who's telling you, hey, here's what's going to happen as far as the equity market goes, or this is a good deal, or that's a bad deal, ask yourself 2 questions. Where were they 2 months ago? And if you knew as an individual, who would you tell? You can have an opinion, that's awesome, but no one knows. No one knows. Your advisors are there to listen to you. If you don't have one, now's an excellent time to consider getting one. The public, as you saw with mutual funds, is one of the best contraindicators that a financial professional looks for. When the public is piling into stocks like there's no tomorrow, guys like me are coming out. When the public is buying bond funds like there's no tomorrow, it usually signals a turn in interest rates. So we look at the public as contraindicators. Dalbar, which is a very good analytics company, did a study a number of years ago. It basically looked at the average performance of a straight index fund over a 10-year period. I think it was actually 20 years. And then they looked at the performance of the average investor. Average equity mutual fund did about 9.5%. Average investor did less than 4%. The difference, plain and simple, is the emotionality that people have as they think about their money. You want to find a good advisor? You want to find an advisor that is completely emotional about getting you where you need to be, and cold and calculating in how they do it. Because they're the ones, the advised accounts are the ones that did better. So if you're advising yourself right now, you've got to become cold and calculating and protect yourself. If you're working with an advisor and they're not aware of this, make them aware of this. We're going to put up a link to a Facebook page. We're going to be available. If your advisor doesn't believe it or he's got some counter argument, I welcome it. Bring it on. Let's see it. But this is an opportunity. If you're an advisor, call every client you have that may have these or even know someone that has these, and do them a favor. Help them out. There's no money in it for an advisor to do this, other than the fact that it's the right thing to do. For those of you that are self-directed and you're in this position, it's dangerous out there. You don't want an advisor that's going to sell you product. You want an advisor that's going to protect you from product, going to protect you from all the great ideas Wall Street comes up with all the time. They're out there. I know they're out there. I trained over 12,000 of them. Find one of them. You'll be glad you did.
link in the chat so people could sign up for the webinar. I know you're going to do that on Tuesday at 2 p.m. Eastern time. Again, it'll be a deeper dive into what we discussed today. Again, folks, this is all free information. Gary is just wanting to help the masses so you can retain a portion of your portfolio, depending on what ratio of your portfolio may be invested in these type of bonds. So Gary, we really appreciate you sharing with us today. And we're going to do this every week, right? Thursday at 2 p.m. Eastern, we will jump on here at LinkedIn Live and continue to inform the masses as we can, as things happen in real time, because things are changing so quickly.
Exactly right, Roger. And I do appreciate your help and being able to produce this as quickly as we have. The best investors are educated investors. And we're going to talk about things that will resonate with the public. We're not going to be talking about specific products. I'm not recommending stocks. I'm not recommending anything specific. My hope through these webinars is to give people enough of a financial background into how to be their best advocate and what to relate to their advisors who are out there and ready and willing and able to help them. So it's a very, very scary time. And the best thing we can do is provide the educational backdrop for people to make good decisions.
Fantastic. Gary Sinderbrand, thank you so much for coming on today. And we will see you next week, folks. Same time, we'll put all the links in the feed right away so you could sign up for the next event. Gary, thank you so much.
Thanks, Roger. Thank you.